Let's look at the stock of Nvidia and see what's going on here. We'll definitely touch on volatility. I'll show you the historical volatility value. We'll also take a look at the trading volume and options, very important levels. Let's see what the market forecasts for this stock after the earnings report. I'll also show you a strategy that allows you to profit both when the company's stock rises and when it falls. Let's start with the very beginning of Nvidia's stock. Over the past 3 months, it has been consolidating, meaning it's been moving sideways. And very soon, this stock will have an earnings report, and there's a high probability that this consolidation will be over. The stock will either start trending upwards or it will start trending downwards, but there's definitely more chance for a decline. I'll tell you a little bit more about that later. If we look at history, earnings reports are the trigger for movement. So if we look at the end of 2022, after the earnings report in 2022, the stock began its rise. It kept rising. The next report also contributed to the rise of the stock, and the biggest rise happened in May 2023, exactly a year ago. And after the earnings report in May 2023, the stock rose significantly and then started consolidating. It consolidated for almost half a year. And as we can see, we rise up to $500, then fell to $400. Again, rise $500, and the next report, which was in May 2023, also served as a trigger. And after that report, after a few weeks, the stock started rising again and rose until the report in February 2024. After that, the stock once again entered a consolidation similar to the consolidation in mid-2023. And again, after this report, some events may occur that will either push the stock up or the stock may start falling. Again, at the moment, the market capitalization of the stock is $2.25 trillion. This is a lot. These are just unimaginably large numbers. But if we look at net income, it's almost $30 billion for the year, with the company's valuation at $2.25 trillion. Personally, in my view, this is a highly overvalued figure. But let's look at the volatility. What's happening here? Currently, volatility is at 60% for some strikes, reaching 70%. This is generally a normal situation when volatility increases before a report. Most likely next week, volatility will increase even further because the options and futures market anticipate sharp movements in price. Let's look at the volatility smile. What's happening here? As we can see, volatility is increasing towards the downside, towards puts. On near strikes, volatility is increasing towards the upside, which is logical because after the report, the market assumes that movement can occur both upwards and downwards. That's about near strikes. But if we look at distant strikes, volatility towards the upside isn't increasing. Instead, volatility towards the downside is increasing significantly. This needs to be considered for forming a well-balanced portfolio and positions. Now let's look at historical and implied volatility. Currently, the white line represents implied volatility, the gray line represents historical volatility, and the volatilities here coincide. That is, they are equal. This is absolutely normal when two volatilities are equal. But what if, for example, implied volatility was significantly higher than its historical value? We could devise a strategy that would allow us to play on decreasing volatility. I always consider such strategies. Today, I'm also ready to show one strategy on it to demonstrate how to play volatility movements. Here we just need to specify, for example, the date we predict what will happen, and also specify the volatility. We agree that volatility will decrease and select approximately by what magnitude, and artificial intelligence will compile and calculate the most profitable strategies for us. As we see, there is a strategy that allows us to earn with a probability of 98%. There is a probability of 96%. Let's look at one of them, and here's what they offer us. It suggests buying one call option with a strike of $770 and selling 2 call options with a strike of $920 for September. This is how our income will look like. This is how it will compare to other strategies. Yes, it's quite complex here, but I immediately say that the strategy is really complex, risky. It also needs to be managed because here you can lose money if the stocks grow very much. I'm showing this solely for demonstration. How to play volatility, how to earn on volatility movements. I don't recommend anyone to open such a strategy. I don't recommend trading with bots, bloggers, or artificial intelligences at all. You should think for yourself and build your own sound strategies. Now let's look at the most important thing, the volume of trades. So we see that we have a decent volume centered around the level of 900. At the moment, this level is an unbreakable wall for us. The stock has been trying to break this level for several days now. Yes, there was an attempt on Monday, but then the stock recoiled and someone asks, why can't we break the 900 level? I'll tell you why. Because we have a huge wall, both in the call option side and in the put option side, meaning derivatives don't allow this stock to grow too much. I always draw your attention to this. It's literally the key to stock movement. If someone can't determine the levels, then I tell you these levels. We also have a very large volume at the level of $950 and $1,000. This is regarding call options. In put options, we also have a large volume at the level of $850. This is of very high importance. It's not certain that we can overcome them, and such volumes are usually overcome after some news or after a report. Yes, a report or some news can shift and break this huge volume wall. Now, let me remind you of my philosophy and how I trade. First, I don't know where the stock will go. I can't predict price movement. My main task is proper position management. If you manage positions and portfolios properly, you will make money anyway. regardless of where the market goes. And personally, in my opinion, if we rely on mathematics and probability theory, buying stocks at the moment is very risky. Again, from the perspective of probability theory, if the stock rises to $1,000, you'll only make $100 per share, but if it drops, say, to $750, you could lose much more. So at the moment, buying these stocks is extremely risky. But again, I'm not saying the stock can't rise, it can. I'm purely operating on mathematics here. According to probability theory, in this case, buying the stock isn't the most rational idea. It's certainly not advice, and I'm definitely not urging anyone to sell the stock short. Think for yourselves. I'm just saying that what I'm doing is not buying this stock at the moment. Of course, if you're a long-term investor, if you believe in the potential growth over the next 5 to 10 years, then the stock could be worth much more. But before that happens, I still think the stock should correct because, in my view, it's significantly overvalued. And it's not just me saying that the market is indicating it. I'll explain more on that later, but the most important thing is the strategy. Let me show you what I mean when I say you can still profit either way. So look, I've devised a strategy using options that allows us to earn $15,000 if the stock is at $1,070, and also if it drops to $800, we'll earn $10,000. Again, no matter which way the stock goes, we profit. Of course, unless the stock is about to crash or skyrocket, the strategy looks like this. But again, it involves selling options, and it's a very, very risky strategy. If you engage in this strategy, you could lose a lot of money. It needs to be managed. You need to sell options at the right moment, buy options at the right moment, use hedges, but if you manage it wisely, you'll certainly profit. So let's see what the market forecasts. Again, this is not my forecast, but the market's. If we look at the market forecast for mid-June 2024, the market indicates that there's a probability of the price dropping to 850. And that's where the highest likelihood lies. The probability curve, again, is driven solely by motivation, which is something I always orient towards. If you maintain a positive ratio of wins to losses, you'll always come out ahead. That's something you should never forget. But let's look at the market forecast for December 2024. As we can see, the market predicts that the price will drop to $770. Again, this isn't my forecast, it's the market's forecast. The market incorporates all the information, derivatives, volatility, hedge funds, market makers, everything is already factored in. And going against the market, in my opinion, isn't the best idea. If you say that I'm wrong to suggest that the stock will likely fall rather than rise, then you're essentially saying that not I am wrong, but the market is wrong. Because right now, I'm basing my views precisely on the market sentiment. These aren't just my unsubstantiated claims, I'm literally showing you the facts. You may disagree with this fact, but it's undeniable that the market is factoring in a decline. Again, if you play against the market, you might make money once, you might make money twice, but in the long run, you'll always lose out. The mathematical expectation won't be on your side. I always say, why go against the market when you can go along with it? If you go along with the market, yes, you might also lose in the short term, but in the long run, you'll win. I also advise you to watch my previous videos where I discuss the conditions under which I'll be building an entirely new portfolio, what goals I'll be pursuing, what specific stocks I'll be buying. Don't miss the start of this experiment, subscribe to the channel.